If you are going to have a fleet of vehicles, why would you not do this? Why would you not say, hey, you know what? We don't need the most brand new vehicles right now. Let's just try to capitalize the system for 4 or 5 years, and then let's add to it. Does this matter if it's taxes? I pay my taxes through my policy. And so could I do that year one? Absolutely not. It took me time to capitalize that system. And then I got to a point where I could be borrowing cash value to pay taxes, and then I can pay myself back quarterly. So it doesn't just have to be trucks. A lot of times we get stuck on that too, that we forget to use our imagination. Hello, and welcome back to the podcast. Thank you very much for joining us. Oh, we have a guest in this podcast. That's visible this time. All right, we are going to go through equipment financing. This is a long chapter. It's a lot of stuff. We're going to keep it short and sweet to not make it so complicated. A lot of what Nelson talks about in here is capitalizing the policy, repetitive. But I just want to start out by saying, if you go to page 54, that is where he's going to start showing us how to buy a truck. He has already talked about putting $40,000 in a policy for 4 years, and he's done that in previous chapters. And so now he's implementing it here. Should you do this? Good gravy, no. And you can't do it. You cannot pay premium for 4 years and be done paying premium. Like the policies that we write, the shortest year is 10. You can't pay premium for less than 10 years. I know that he says he's using dividends to continue to pay base premium. He would not recommend that. He talks about that in this chapter. So this is just to illustrate how you would capitalize a system and finance those vehicles. Nelson tried to basically say, hey, this is how you should be thinking and be creative about it. And we take everything in his book literal, which causes some problems.
Yes.
Okay. So this is an illustration of how this can work. All right. Trissa loves this chapter, so it's all Teresa.
I do love this chapter because I'm just a numbers gal. I'm just like that.
Remember, she has an Excel spreadsheet. She probably does a pie graph of what they spend money on.
I'm not going to share anymore about my nerdy Excel sheets. I'm just kidding.
Then what are we going to pick on?
I do love them. I think they're great. Very informative. Everyone should do it.
If you need an Excel spreadsheet,
I'm your girl.
Teresa at withoutthebank.com.
Okay, no, but this is actually my favorite chapter. I'm not even going to lie to you. It really is. Because I think what Nelson, to your point, he's trying to distill this idea. And the reason why I think he excluded the premiums for those years after 4 is because he wants to show you the profitability of banking. So it's like you've capitalized your system. Now here is how much money the banking system is already making off of you. But here's what this looks like inside of your policy. So in this example, the gentleman's paying $40,000 per year. He's financing his logging equipment truck. And I'm just going to go through some highlighted things before I get into the Spark Notes version of what my takeaway is from this chapter. So the first thing that I have highlighted is he outranks all possible borrowers in access to the pool of money that must be lent to make the life insurance plan work. And then he goes on to say, look at how you're building equity in your equipment, because essentially he is paying off these logging trucks through the bank, and his accountant is excited that he's building equity in his equipment. And then he goes on to say that's true, but he's building equity in the wrong place. He should be building equity in the banking business that finances his trucks. Everyone should be in 2 businesses, the one in which you make your living, and the other should be the banking business that finances whatever you do for a living. Of the 2 businesses, banking is the most important. Businesses come and go, but banking is eternal. So essentially what he's saying is, if you have equity in your trucks, you're limited in your options of what you can do with that. If you have equity in your banking system, how many options do you have available to you? It's not just limited to your truck. You could be making a hard money loan to someone else. You could be putting money down on real estate. You could be paying for marketing your business. You could be using it for taxes. Like, It really is an exercise of imagination because you're not limited. Whereas if you have equity in one place, typically you are limited and someone is making the rules around how you're able to use that equity. And a lot of people don't think about that. It's like if I have equity in my home, well, I have to have the qualifying income to maybe get a HELOC or a cash out refinance. And then I'm still not able to use 100% of my equity. Whereas if I have the equity in the right place under my ownership and control, I could use it to my discretion. Okay, so basically he goes about financing the logging truck, which is, is it $40,000 or 52? Let me see. You'd think if it was my favorite chapter, I would know that.
52,600.
Yeah, 52,600. Okay. So he says, pay close attention to this point. It is vital that you understand he must set up a loan repayment plan that equals or exceeds what he would have had to pay the finance company that he was using in the past. So if you go to page 54.
And he's talking about paying extra interest as well.
Yes, and extra interest, because this used to confuse me. It's not complicated. Extra interest just means more premium. That's it.
Yes.
More premium. That's all that means.
And Nelson talks about this in the... So let's get this out of the way right now. The extra interest that he's paying in this chapter is what's making these policies grow.
Yes.
It's not magic. This is where people think, if I take a loan, I make money. You only make money if you pay the extra interest into a policy or a new policy to increase cash value. So in this chapter, anything extra is not actually going into one policy either. People think, oh, it's just one policy. And Nelson says right here, remember, all he could do is add additional policies to his banking system as early as possible to enhance his ability to finance his entire inventory. So when people read this, they're like, oh, look it, you make money taking loans. No, you make money paying extra interest.
Premium makes you money.
Right.
Yeah.
So let's get that out of the way before, and that's, again, Nelson has to, on the bottom of page 58.
It does.
Actually, this interest is not really interest. It's additional premium. But it's this tiny little footnote that nobody reads.
Right.
And so that little footnote should be like in bold with flashings that should like pop out. It should like be a pop-out book.
Yeah.
Because this is where a lot of this misleading of this industry of the infinite banking concept has come from. That it's a magic pill to make money buying cars. Oh, I can just make money buying cars. No, you can't. You can make money by paying extra interest when you buy the car, but it's going to be self-discipline.
Yes. And that actually, it took me a little while to understand that when I first started in this industry because of how it was talked about. So I'm glad that we're going over that so people aren't confused.
Yeah, let's just get it out of the way. Hit it head on.
Okay. So if you do have your book handy, what I liked to do is write finance one vehicle on page 59. Finance 2 vehicles on page 60, finance 3 vehicles on page 61, and finance 4 vehicles on page 62. And I would bold capitalization right. Premium makes me money. Just so
good call.
When you're going back through this, you're not confused as to why this is working.
And this is exactly why in life without the bank and farming without the bank, I didn't pay any extra interest. No extra interest was paid. We paid interest to the insurance company and we did not pay extra interest because I was tired of answering this question. So my books, yes, I talk about paying extra interest, but I don't show it.
What was the reasoning behind that?
So that people don't think they make money taking loans.
Okay. That makes sense.
One person can write it. We don't need to have multiples.
Yes. So if you look at this, all you're really doing is adding scale to the equation. So if you go down to his age 66, he starts taking out his retirement income.
Well, first we fund it $40,000 a year for 4 years.
Right.
Okay. And then
he buys a vehicle every 4 years and pays it back with interest.
Yes.
Interest.
Yep. Well, the first, what page are you on? 54?
59.
Okay, so let's go to page 54 first, if we can. So 54 is just a basic illustration of saying, hey, we're going to fund this thing for 4 years, and then we have cash value of 157. Okay. And if he didn't buy anything with it and he didn't do anything with this policy, he'd have $92,000 a year that he could use for retirement. Now, if you guys go to page 56, he's saying, hey, I'm going to buy one semi. If I lease that semi, this is how much it's going to cost me. So what he's doing is he's being an honest banker. And he's using the same numbers from the lease company when he buys the semi as payback. So he's going to buy the semi with his policy, through his policy, but then he's going to use those payments, the lease payments, as a payback. Okay.
Yes, that was good. Thank you for covering that. I just got so excited and hopped around. So essentially the only difference between the first page that we went over of him capitalizing his policy and page 59 is the additional interest that he is putting into his policy. So the additional premium.
Yeah. So page 59 is where we capitalize, then we're going to borrow, and then we're going to pay back every single year. So the reason that year 5 is $34,000 negative outlay is because that is the year that he bought the semi. So $52,600 minus a payment of $18,000 because he bought the semi and made a payment in the same year. So he has a negative $34,000 to buy that semi. Then every year after, we have $18,000 of repayment going in. Now year 9, what did we do? Bought another semi. The same $52,600 minus 18. That's why it's 34. And then it's just repetitive from that point forward.
Basically,
This is not rocket science,
it's
right?
very simple. And I think what's so great about this is he's still building equity in his vehicles. He is just also building equity inside of his banking system.
Mhm.
And I think that's why people get so caught up on the either or. It's like, oh, well, I have money for this or I have money for a policy. And it's like, no, your policy should be your home base. And then whatever happens after that, the money should return back to the home base. And I love that when he's 65, if you look at cumulative net outlay, which just means the amount of money that he's put in this system up until this point is at $315,200. But if you look, he has access to almost $2 million.
1.9,
Yep. And
which is in the illustration, the very first illustration where he was just funding it, not using it, is 1.5. So that extra money of $300,000 is what?
additional premium.
Additional premium because he was honest and said, hey, if I'm going to pay the leasing company X amount of dollars, I'm going to pay myself that same amount of money.
And then if you look, he's able to take out $100,000 the first year, $125,000 onward.
Instead of 92, which is what he was doing with the first policy. What I like to do is like
Yeah.
do
right,
this
like
to my book so that I can see the difference. And then if we go on to the second truck,
So now he's financing 2. And notice his payment doubled. So instead of 18, it's at 36. So that's all we're doing is just we're adding scale to the equation.
So at retirement now, he's got $2.4 million instead of $1.5 million. If you double it, this is where Nelson always used to say too, it's all relative. If a client comes in and says, oh, I want to see a $50,000 policy and then I want to see 100, well, just double it.
Times 2.
Yeah, just subtract. Cut it in quarters, cut it in halves. I don't really care. It's all relative. It does make a difference a little bit when you get into much bigger numbers, but it's still fairly relative.
Yeah. And the thing that got me so excited about going through these examples, though, is looking at how much he's effectively paying and what that means for him during passive income time or when they're probably slowing down. So in the second financing 2 trucks, he has put in $470,400 He has access to 2.4. This is at age 65. And his death benefit is at 3.9. So if you scroll all the way down to cumulative net outlay, he's been able to take out over $2 million of this system.
Been able to borrow against.
Excuse me.
$2 million because he just ran the second truck through the system. But what if he got into a year where trucking was bad? Like, trucking is not the best industry to be in, man. It is a tough industry. Well, what happens when I blow an engine? And there goes 60 grand. And so now what if I can't make my loan repayment? Then you just don't make your loan repayment.
Tack it up.
And you have the luxury to do that. I know a number of people that are truckers. And they're like, yeah, my truck's just sitting because it's broke down. I owe more on it than what it's worth. And so I don't even know if I'm going to fix it. Because trucking is a hard industry. So if you can move that control back over to you, it would be that much better.
Well, that's what Nelson said, right? If the trucking business is hard, or if you don't feel like being in that business anymore, where's your equity sitting? In that guy's truck.
Yep.
Versus if you had taken the time to capitalize your banking system, then it would be in your banking system and in your truck. It gives you more options.
And so guess what happens with 3 trucks? You triple it.
What?
And the numbers just triple. Guess what happens with 4 trucks? The numbers quadruple. I would love to say that this is rocket science, but this is not rocket science. It is just that simple, that this is what's happening because you are putting more premium in.
The more you put in, the more you can get out.
Right. And so Nelson is just saying, if you're going to have a business where you're going to have a fleet of vehicles, can you capitalize a system first and start buying that fleet through your own business? I don't care what kind of contractor you are. I don't care if it's semis. I don't care what it is. If you are going to have a fleet of vehicles, why would you not do this? Why would you not say, hey, you know what? We don't need the most brand new vehicles right now. Let's just try to capitalize the system for 4 or 5 years. And then let's add to it. Does this matter if it's taxes? I pay my taxes through my policy. And so could I do that year 1? Absolutely not. It took me time to capitalize that system. And then I got to a point where I could be borrowing cash value to pay taxes, and then I can pay myself back quarterly. So it doesn't just have to be trucks. A lot of times we get stuck on that too, that we forget to use our imagination. What are these big ticket items that we're buying? And that's what I talk to my clients about a lot. What are these big ticket items that you're buying that you could be running through the policy? If you get done paying for a combine, or you get done paying for a tractor, or you get done paying for an office building, can that money be redirected? Yes. And we should be redirecting every dollar of it, beating Parkinson's law. Not what we were doing when we were talking about Parkinson's law on that podcast. That podcast is saying, hey, I freed up 100 grand, but maybe I'll do 25. Why wouldn't you do all 100? Because you were used to that money being gone. It was never anywhere you could touch it.
Well,
now it's
losing
building.
It. Right. It's like you still have access to it. You're taking money from one pocket and putting it to the other.
Yep.
So, yeah, this is just my favorite chapter. But like I said, I just like the numbers. I'm like, oh my gosh.
And it's a big chapter, it's a long chapter. And I know that there are people that can teach this and it can take them an hour. I just don't think we need to make it that complicated.
It's not.
I mean, the first time I read it, I have all kinds of like little notes on the side, and everything's explained. And after I got through the second truck, I was like, okay, we're good. Like, I literally have no notes on the 3rd truck, and I have no notes on the 4th truck because it's the same thing. You just triple or double it. I think the biggest thing is just understanding that you're going to have to capitalize, and that is a dead horse we have beaten for an excessive amount of time because Nelson repeats it and repeats it and repeats it because he has to.
Yeah. I remember when I was first telling my mom about this concept, and we were driving in the car, and I felt so proud because at this point I was, when you're first into infinite banking, you don't shut up about it. You tell everybody about it. And I think at this point, my mom had already had her policy, but she just was like, oh my gosh, I finally get it. She's like, you want to put as much money as you possibly can in there. That's sustainably. And I was like, yes. Yes, Mom. Never felt more proud. And I have 3 kids.
Oh, that's funny. He says in the addendum as well, the system consists of many life insurance policies, and the number of years each policy is capitalized must increase when interest rates go down. And so people, when they read this chapter, they think that this is all one policy. It can't be one policy because of the MEC. So we have to do a system of policies. A lot of people like to jump to these numbers and jump to this chapter, just like a lot of people like to go to the numbers in my book and they like to skip the first half of the book. The first half of the book is the important piece. This stuff is just numbers.
Well, it's just where you're getting started. That's all.
Right. And so you have to understand, if you skipped over the MEC chapter, you're going to think this is one chapter or one policy, but you can't skip over all of those things. So anyway, none of the figures that you're going to see are set in concrete. They will vary with interest rates and how you treat the system. Your behavior as managing the system is the most important factor in the entire equation. We haven't heard that before. Okay. I don't think I have anything else on that chapter. If we miss something, I'm sure you guys will let us know. But you know where to reach us. So Mary Jo at Without the Bank or Trissa at Without the Bank. But read that chapter and don't make it that complicated. And there's not that much to go over in it because a lot of what he was saying is repetitive to everything we've already gone over in previous podcasts and previous chapters. We don't need to be reminded of it. I would sure hope by now you guys don't need to be reminded of it. So let us know how we can help. Schedule your appointment and we'd be happy to have a meeting with you. Have a fantastic rest of your day.